This is a video lecture for ACCA Belfast P2 Corporate Reporting. With this video lecture, we're going to be looking at leases as they are accounted for under IAS 17, and we're going to be looking at them from the leases perspective. Under IAS 17, there are two types of leases that a contractual arrangement can be put into. So it's either going to be a finance lease or an operating lease. So whenever it's a finance lease, the risks and rewards of the asset are transferred to the leasee. So if you think of the example of leasing a car, the rewards that are transferred is that you can go anywhere you like and use the car whenever you want. But the risk is that if anything should happen to the car, then you're going to be responsible for for picking up the bill basically. Another way of determining that it's a finance lease is the incidental ownership is transferred to the leasee. Now this normally comes at the end of the lease, and it would quite often come whenever they have to pay a nominal fee on top of this. And this would also indicate that it's a finance lease. This is a checklist that you really should know whenever you're going into an exam, and whenever you're presented with a scenario where there's a possible operating or finance lease. Use this checklist against the information you're given in the question to determine and to make an argument that it should be classified either as a finance lease or as an operating lease. So here we have the ownership that we were talking about just in that previous slide. The option to buy, this again is linked to the ownership in that at the end of the finance lease that you would maybe pay a nominal fee in order to fully own this asset, in order to wipe out that obligation that you have to be making finance payments to this company. If the finance lease is leased by yourself for the majority of the economic life, then this would then indicate that nobody's going to really be able to use this after you have leased it. So therefore this would then indicate it's a finance lease rather than an operating lease. So an operating lease could be, something maybe like a photocopier where you're just paying a rent, a quarterly charge perhaps. But then if you only have this for a year, somebody else could take that copier and then use it for their business. Whereas if you're using it for the majority of the economic life, then nobody's going to be able to use this afterwards. Another indication is the present value of the minimum lease payments is approximately the fair value of the asset. Again, this would be an indication that it would be a finance lease, and quite often you would be given the fair value within the question. So just go through, and highlight any bits that information, whether it be figures or any narrative that you think is going to determine that this is going to be a finance or an operating lease. Quite often you'll see in exams, maybe a manufacturing company, and they're going to be leasing an asset that's specifically designed and has been specifically made for them. This would be a strong indication that it is going to be categorised as a finance lease. Otherwise, nobody else is really going to be able to use this. So again, if you look back to the major part of economic life, this is going to show that nobody else is going to be able to use this after the lease. So therefore, it would be a strong indication again that it's going to be a finance lease. And then any gains or losses, that's sort of the risks and rewards aspect we were talking about earlier, are borne by the leasee. Substance over legal form. Now what we're talking about here is that perhaps a contract specifies that this is not a finance lease, but whenever you're going through that checklist and you can see the contractual arrangements that exist, all indications are pointing that this should be classified as a finance lease, and that the proper way to account for it and to show a true reflection of what this economic arrangement is would be show it as a finance lease. If so, then you would need to record it as an asset but also record the liability. So this is a key area that the examiner often likes to bring up in the exam, this substance over legal form. So if you're told in a question this has been classified as an operating lease, question this. Run through that checklist, and even if you come to the same point that it is an operating lease, at least you've still shown that knowledge that you know those checklist points. So the accounting treatment of a finance lease. The initial recording would be the fair value or as the present value of the minimum lease payments, and you have to show this as an asset in your statement of financial position, but then again you need to show the corresponding liability. So there's two entries to be thinking about here in the statement of financial position. This asset needs to be depreciated. So for example, if you're thinking about that car again, you're just going to depreciate it over the years, as you normally would. So it's going to be over the short of the useful life and of the lease term. So whichever period is shorter of the useful life and the lease term is what you're going to depreciate over. So again, you're going to need to read the asset and then also charge this to the income statement. The payments of the finance charge is going to just be a direct hit to the income statement, but again, this liability that you owe the financing company is then going to be reduced steadily. So there's quite a number of things to be thinking about really. There's going to be your asset, your liability in the initial recognition, depreciation, finance charge, and then also reduction of the finance liability. So if it's an operating lease, if you go through that checklist and you're basically saying that this should just be an operating lease, there's nothing to indicate or there's no strong indications it's a finance lease, then it's an operating lease, and any other lease is going to be classed as operating. So you don't need to recognise it as an asset, there's no depreciation, and it's just basically a hit to your income statement, which is just far easier. You're obviously hoping that it's going to be an operating lease that comes up in an exam, but realistically, because he's wanting to test you, the examiner's not going to make it that easy. So if it is incorrectly categorised, what's going to be the effect? Well, with the finance lease, you have the asset that's recognised in the statement of financial position, and the operating lease, then it's not. So that's going to be the key difference. This asset and liability you've recognised will not be there if it has been incorrectly categorised as an operating lease. Now, this could have various effects on, the gearing ratios of the company. And again, perhaps they're, coming close to some covenants that they've arranged for certain loans, so they may want to be taking this out of their statement of financial position. So always just sort of bear that in mind. Would there be a reason why they wouldn't want to classify this correctly? And if so, why are they doing this? And how can you ensure that what you're taking from the scenario, that the information you're given, that you are actually analysing and using this correctly? So just in summary, the main points you're going to need to consider whenever you're doing these lease questions is the categorisation. So you have two accounts, finance lease, and then anything else is an operating lease. Your income statement hits, so that's going to be your finance charge and your depreciation. So your finance charge will be in both instances, your finance and your operating leases, and your depreciation is going to into effect if it's finance lease. The statement of financial position, this is going to be if it's a finance lease, assets recognised, liabilities recognised. Operating lease, there's no impact on the statement of financial position. Lastly, is there any reason to misclassify these? Have we been told that there's maybe a company that's in financial difficulties, or that they maybe have loans which are affected by certain ratios within the company? Maybe there's an indication that they would want to not show liability, for example, for a finance lease, and just want to classify as an operating lease. Because just because you're going to break one of your covenants by having too high gearing or whatever in your statement of financial position never overrides the rule that you should be giving a true and fair reflection of your company's position within the statement of financial position. Thank you very much for listening, and I hope you have enjoyed this little video cast of leases.